Finally, invitation to Mark. Paper has come all the way from South Africa to come and talk to us about a really exciting program that they have investing in small, medium-sized enterprises in many countries now across Africa. And Mark, come and share your story. Thank you.
Thank you. Thank you very much, everyone. First of all, it's a great honor. Thank you, Kim. Thank you, Andrew, for inviting us. We met with Andrew in December last year, and you encouraged us, so thank you very much. I do appreciate that it's Friday afternoon. I do appreciate that it's late, so I'll try to get through it as quickly as possible. I'm going to talk about Business Partners, which is an organization I've been working for the last 20 years. My actual age is 22. I'm in fundraising mode at the moment, so that's the reason for my physical appearance. But, all right. Business Partners, we're an organization that focuses particularly on the lower end of the SME space. One in which believes that if we can create wealth within the individual investee companies that we invest in, they in turn will create jobs. We also believe that by doing that and by doing it sustainably, we're creating a vehicle that we would want to be part of, being business partners. Basically, who is Business Partners? We were established about 30 years ago. It was a joint venture between government of South Africa and big business in South Africa, where it was recognized that there was perhaps a gap in the market, that missing middle that we spoke about. There was identified as a need that we needed to provide a vehicle that was going to provide finance to the SME space. And when we talk about the SME space, we're talking particularly the lower end of the SME space. Our primary market is in the space of $50,000 to, we operate $50,000 to $2 million, but generally we like to play in the space of $200,000. That's the typical type of transaction that we want to do. We established the company with an original capitalization of 20 million, and through the recycling of the funds, through the implementation, the successful implementation of the model, we've been able to grow that the institution to having a net asset value of around about 380 million, with an investment portfolio of 300 million. Made up of around about 3,200 active investments. These investments average at around $200,000 per investment. As I mentioned, we have an investment mandate that says that we can operate anywhere between $50,000 and $1 million. We can go slightly higher to 2 million. But generally speaking, the typical sweet spot of market that we want to play in is the lower end of the SME space, that $200,000. What I thought we would do today, instead of telling you all the challenges that one is going to be faced with or one is faced with, I thought what we would do is just stand back, and if we can look at what Business Partners does well, we think, what we think has enabled us to have this model be recognized as being sustainable, being able to do business in volume, to do business on a sustainable basis, generate a fair return for our investors, have impact because we're playing in the lower space of the market, giving recognition that the biggest challenge that this environment has is the cost effectiveness of trying to do business in this space. As the previous speakers have mentioned, trying to do due diligence on an $85,000 transaction is perhaps just as costly as a transaction of $1 million, or if not more. So what I've tried to do is look at what it is that we at Business Partners think we do right that enables us to do well. I think the first thing is that we have an exclusive focus on SMEs. We have this higher investment mandate where we can go up to $2 million, but we really don't want to play in that space. We like the space of $200,000, $300,000 transactions. We live and breathe the SME space that we play in. Just to illustrate this point, I think it's been quite interesting to listen to the other speakers as well, because it really reconfirms the different roles that all the different entities have to play. The role that business partners plays is not a typical private equity, not a typical venture capital role. The lifestyle businesses that we target are not your typical high growth businesses. These are not businesses that are showing huge growth potential that can regionalize over a short to medium term. The lifestyle businesses that we target are your typical mom and pop shops, your supermarket, your butchery, your laundromat, your small scale guest house, etc. These are typically run family owned businesses that establish the crux of your middle class that so many economies are not necessarily with, and we believe we have impact by bringing that about and focusing on that. Now, there's a number of reasons why people don't want to focus on that business, focus on that segment. Banks don't like that segment. It's too high risk. It's undersecured. Private equity typically might not want to play in that space because these are not high growth businesses. You're also faced with the cost challenge of due diligence, and you're also faced with the huge cost of how you're going to exit at the end of the term. And these are the challenges that we think that we've tried to overcome. The next issue that we think we do quite well is that we've developed the business partners model to enable us to perform due diligence en masse, to enable us to get young investment graduates, have them act as investment officers, and in the short term send them out into the field and be able to assess whether or not they can do business with a supermarket, whether or not we should be doing business with a guest house, etc. And we've been able to do that en masse. And how we've done that is by introducing efficiencies into the system. So our whole business structure, our whole business model is geared around doing business in volume. We gear up our investment teams with as much information as possible so that they can make quick decisions, so that we can get these relatively inexperienced investment officers making decisions at an earlier stage in their career than possible without all the support information that we provide them. In terms of the actual due diligence process, we do it ourselves. In terms of the legal review, preparation of our legal documentation, we've systemized that. When our investment teams are spending time with the investee company and developing the term sheet of the deal structure, simultaneously to them inputting those terms, we have a system that simultaneously develops our shareholders agreement. So when the investment committee makes a decision on Friday afternoon, the shareholders agreement is ready on Friday afternoon. So this systematization brings about efficiency, cuts down the cost, makes it more attractive for us to look at small transactions. But we need to look at those transactions then en masse. And that's why we do anywhere in a particular financial year, anywhere between 400 to 700 transactions in a year. These are just a list. It's a hell of a busy slide, but these are just a couple of the systems that we've introduced into the organization so as to make sure that when we do business, we do it efficiently, we do it effectively. We get our teams to make the right decisions quickly. We get them to make the right decisions so that we're not just good at giving money away, we are also able to recover that money effectively. And all of these systems have been developed very much around making sure that we are capable of doing that. I think the next aspect that what we've tried to do over time is, and this is something that didn't materialize necessarily at a session where we said this is the type of business we want to target. It's really morphed over time. And that is the type of product offering that we make available to our SMEs. What we've tried to do is we've tried to say, what is preventing a bank from going in and looking at business within the SME space? Is it because of the lack of security? Is it because of the high cost? Is it because of the cost of post-investment management, et cetera, et cetera? We've looked at all of those aspects of what's prohibiting banks from doing that business effectively. We've then gone on to the other end of the spectrum and looked at what would a private equity player not want to do this? Why would a private equity player not want to do this type of transaction? And generally speaking, it's because the type of businesses that we do are not high growth businesses or not even medium recognized growth businesses. These are lifestyle businesses that are probably going to grow on a marginal curve. Also, there's huge challenges with regards to exit. How do you exit from a mom and pop business when in all likelihood you're going to be selling back your shares to the majority shareholder? So what we've tried to do, we've tried to develop products that behave like equity, are patient in their nature, behave like debt in order to be able to self-liquidate our return. So during the investment period, we are getting our exit, rather as opposed to waiting until the end of the term to get our exit. Often what happens is if we're going to invest, for example, let's say we're going to invest in a supermarket and expect to get a 26% return through the sale of the shares back to the majority shareholder, it's unlikely you're going to get that type of return. So instead what we do is we realize our return throughout the term of our investment, the self-liquidating type of asset. But also what's important is what we've tried to do is align the cash flow of the business very much with the type of funding that we make available. It's pointless making funding available where the business cannot afford to service this obligation. Often banks don't want to do business with startups or early stage businesses because they don't have a track record, or because during that early stage they don't have the necessary growth trajectory as far as free cash flow is concerned. So our product is structured in a way that will alleviate that problem. We try and then be more flexible, be more patient in terms of the capital that we make available. I thought it'd be of interest just to give you a little bit of a breakdown, the type of makeup of our funding. Generally speaking, probably only about, let me just go through that, that's about 40% of our total funding is in the form of some equity, some form of equity. We've actually taken up an equity position in these small companies. The balance is in the form of some form of profit sharing or mezzanine type debt. In terms of our sector focus, we are fairly geographical in our focus. We see as our growth strategy that we are wanting to do business in East and Southern Africa. In terms of the type of business that we do, we don't have restrictions there. We believe that we do business with SMEs. And not necessarily SMEs within the medical fraternity or within the tourism or manufacturing. We do very broad-based. If a client, whether they be in all of those sectors, fit within the profile of business that we want to do, we are interested in doing business with them. So in terms of our portfolio makeup, we have across the board manufacturing, we have call centers, we have small hotels, we have little butcheries, we have supermarkets, we have small law firms, you name it. All of those type of businesses that make up the profile of a typical SME. And we think by, once again, reiterating that focus of just wanting to do business with that the smaller version of the SME, we have developed over time a specific skill set, a specific understanding of this market, and we are able to then pass that on to our young investment professionals and help them make these decisions relatively quickly. Okay, sorry, let me just skip that. I think the next thing that what we've found over time is, given the type of business that we do, given the size of the businesses that we are doing business with, without technical assistance and support, in other words, without post-investment management, we think that many of our transactions would struggle. So we, alongside all of the funds that we have, we bring in a parallel technical assistance fund, and we make this funding available to the investee companies in the form of soft funding. It is repayable. We do believe in the principle of repaying. It shouldn't be in the form of grant, but we don't have any interest raised on it, and we also defer the payments quite significantly to align it with the cash flow. But this technical assistance is used first in addressing the problems that we might find during the due diligence stage, when we first deciding whether to do business, and like you mentioned, a large portion of our funding is used to develop the financial reporting abilities of our clients. Most of our clients cannot do financial reporting. So one of the first things that we do is we bring in the software, we train the bookkeeper from being a bookkeeper to an accountant, and make sure that on a monthly basis they can generate monthly management accounts that would enable us to understand where this business is, but also more importantly enable the client to understand where the business is. So we spend a lot of technical assistance on that aspect of it. We also spend quite a bit of technical assistance. A lot of these businesses are moving in a direction where they're starting to recruit staff. They've never had an HR policy. They've never had the employment terms and conditions. They don't have necessarily safe working environment conditions, and this will then introduce technical assistance to develop and to refine and make sure that these businesses, although very small, are applying the best practice that we can have them. We also recognize that the technical assistance can be used in other times for turnarounds. When our businesses are faced with huge challenges, when they are looking doubtful, we introduce the technical assistance in a hope that we can then bring in a mentor who has external experience directly running these types of businesses and can get involved in turning around the business. So we do believe that the technical assistance tool is a fundamental tool of ours in helping us do the business that we're doing. I think that this slide will just give you a little bit of an indication. If we look at the types of businesses that we do business with and the reasons why they fail, generally speaking, we think we can resolve them. If you look at the furthest portion, it's quite a busy slide, but generally speaking, if you look at the issues like bookkeeping and financial records, lack of management competency, but I would say that's more of a due diligence problem than a resolvable problem. But many of these things can be resolved by bringing in mentors or technical assistance, and thereby making it attractive for one to do business with this type of profile of client. I think the last thing that we really do believe is important for us, and that is our investment teams themselves. The previous speakers have also mentioned it. When we roll out our funds we have funds at the moment in Madagascar and Kenya and South Africa and Mozambique, Rwanda. When we put these funds in place, we think it's absolutely vital that we only recruit local staff. So we don't bring expats in to do the business. Expats don't know the market, don't know the culture, can't generate the deal flow, can't do the due diligence. So we really make sure that the teams that we recruit are local teams from those countries, having a network, having an understanding of the market. That's the one aspect of it. The second aspect that we do is we really align the interests of our investment teams. We believe this whole principle of cradle to grave. Our investment professionals are responsible for finding the investments, doing the necessarily all the due diligence, implementing the technical assistance side of it, managing the portfolio post-investment, and all of that whole aspect of it that allows them to get ownership of it. And when there is an eventual exit, we get our investment teams to deal directly in that exit. So we've taken the principle of carry that's applied in the private equity space and applied it in our small environment as well. And by making sure that there's ownership of the investments, by making sure that the investment teams are motivated to make sure that our businesses succeed, we think also is a significant benefit. These are all, in our view, the reasons why we are able to do business in this space. We think these are, if we look at the type of business that we do, when we motivate and incentivize our investment teams, we also drive them on the basis that 40% of all of our measurement is driven by impact. We want to do business with indigenous entrepreneurs. We have a slight bias for doing women entrepreneurs. We don't want to do business in the main economic hubs. We like to do business outside. So We have a fund in Kenya. It's pointless going and doing all our investments in Nairobi. We try and get our investment teams to do business outside of Nairobi as well. So they are incentivized on that basis. Skills development of the investee companies and the entrepreneurs that we invest in. Our teams are incentivized in developing those skills as well. And then, yes, we are a sustainable model. We do have a focus on profitability, and we make sure that that is also brought through in the message, which then we believe enables us to achieve that balance of having impact, having a social impact, but certainly doing it on a sustainable level as well. I think just to run through some of the numbers, just to give you an idea, that's why we think we think this type of strategy can work. We've done 32,000, just over 32,000 investments over our investment life. Our active investment portfolio is around about 3,200 active investments at any given stage. And then, as I mentioned, in terms of the type of volume, the type of number of transactions that we do, our model is driven on the basis that in order for us to have real impact, if we're playing in this space, we need to touch as many SMEs as possible. And so it's the whole basis of doing volume. Just some other quick indicators, just in terms of the growth of the portfolio. I think some of the questions might be had is if we're doing our own due diligence, if we're doing it in such a quicker turnaround time, if we have young investment teams doing this for us, are we then able to secure the quality of the portfolio? And I think those figures indicate that the answer to some extent is yes, we are able to do it. And then the very last slide, I think, indicates that we can do this on a sustainable basis as well. So at the moment, we've been operating in South Africa. I'm just going to have a quick punt, if you don't mind, Andrew. We're operating in South Africa. We've rolled out our business model into other parts of Africa, including Madagascar, Kenya, Mozambique, Rwanda, and we're currently fundraising for a Southern Africa fund, which will include Namibia, Zimbabwe, Zambia, and Malawi. But thank you very much.
Mark, thank you very much sharing with us your experience of after 32,000 investments, 400 to 600 investments a year. Phenomenal, and I think you've shown a different kind of model, and I think this kind of self-liquidating structures, royalty-based or cash flow-based, I think in this kind of sector that we are all operating in, I think is a very neat way of doing